Mortgage delinquencies are on the rise in 2025, up 5% in just 1 month. That's the sharpest jump we've seen in years, and it's pushed delinquency levels to a place we haven't been since 2007. Now I know what you're probably thinking, 2007? It's a year before the housing crash in 2008. And yes, that comparison definitely gets people's attention. But here's the key, while there are similarities, this is not a repeat of 2008. Still, this is a warning sign for homeowners. It tells us there are cracks forming. And if you own a home or you're thinking about buying one, you need to understand what's going on, who's most at risk, and the strategies you can use to make sure you don't become one of those delinquency statistics. Real quick, for those who are new here, welcome. My name is Asher Benjamin. I'm a loan officer with Nexa Mortgage, the largest brokerage in America. I work with over 270 banks, which gives me a front row seat to see what's happening across the entire mortgage landscape, not just one bank or one product. My job is to help buyers and homeowners make smart moves with their mortgages, whether that's buying your first home, refinancing to save money, or protecting yourself when the market gets a little bumpy, kind of like it is right now. So if you want updates that are practical, easy to understand, and cut through the noise, hit that subscribe button because I bring these breakdowns every single week. So let's talk numbers. According to the latest reports, mortgage delinquencies jumped 5% month over month in June. That's not year over year, that's in a single month. And when you look under the hood, it's being driven mostly by two groups of loans: FHA loans, cash out refinances. FHA loans are the backbone of first-time home buyers in this country. They allow people to buy with 3.5% down, lower credit scores, and there's flexible guidelines. But because of that, FHA borrowers don't have big savings cushion or a ton of equity to fall back on. Then you've got cash out refinances. These surged over the last few years when home values went up and people tapped into their equity to pay off credit cards, remodel their homes, or just cover life expenses. That's fine when your rates are in the 3s or 4s, but these loans are sitting at 6 to 8% with higher balances. And when the payment shock hits, that's where trouble starts. Put together, these two loan types are creating the biggest chunk of delinquency growth right now. Now, why exactly are we seeing this? Few key reasons. High interest rates. If you bought a refinance in the last couple of years, your payment is simply higher than what we're used to. A $400,000 loan at today's rates costs hundreds of dollars more each month compared to just a few years ago. That stretches budgets. There's also inflation. Groceries, gas, insurance, utilities, everything is more expensive. So if your mortgage already feels tight, then your grocery bill jumps $200 a month, something has to give. FHA loan profiles. These borrowers do tend to be entry-level buyers, maybe with less stable jobs or lower reserves. They're the most sensitive to even small income changes. Cash out refinances. As we just talked about, people essentially turn their homes into ATMs. The problem is that debt consolidation only works if you stop using the credit cards. A lot of households are now carrying new mortgage debt, plus those old credit card debts starting to creep back up. There's also job market stress. On paper, unemployment is still low, but layoffs are hitting tech, retail, and even logistics. And if you're self-employed or working variable hours, that inconsistency kind of makes it hard to keep up. So bottom line, this isn't one single factor. It's a mix of high costs, higher debt loads, and households that don't really have a big safety net. So who should really be paying close attention to this trend? Well, if you've got an FHA loan, especially if you put the minimum down, if you did a cash out refinance recently and your monthly payment jumped, if you're living paycheck to paycheck with little or no emergency savings, or if your income is variable, you're self-employed, commission-based, or you gig economy work. Please hear me say that it doesn't mean you're destined for trouble, but it does mean you need to be more intentional about protecting yourself. Because the truth is, delinquencies don't start with people who have 6 months of savings in the bank. They start with people who don't have a backup plan. Now, let's zoom out and talk about what this could mean for the housing market as a whole. For homeowners, the risk is clear. If you can't make payments, you could face foreclosure. Foreclosure wipes out equity, even if your house is technically worth more than your loan. For buyers, this could create opportunities. More distressed sales means more inventory, and inventory has been our biggest challenge for years. We're already seeing slight increases in available homes on the market, and while we don't wish for anyone to face delinquency, the truth is that delinquencies could add to that in certain areas. For the overall market though, this is not 2008. Back then, people had loans with no documentation, no income checks, no real ability to repay, no nothing. And when the market tanked, they had zero equity to fall back on. Today, lending standards are stricter and homeowners have record high equity. That's a huge difference. So while we may see regional pain, like cities with high FHA concentrations or places hit with layoffs, this isn't the start of a nationwide collapse. All right, let's talk about solutions, because here's the truth. If you're proactive, you can absolutely avoid becoming part of these delinquency numbers. Here are 5 key strategies that you can use today. The first thing you need to do is build an emergency fund. Even if it's just 1 or 2 months of mortgage payments, that buffer buys you time in the case of an emergency. Think of it as a shield. The next thing is you can refinance smart. If rates drop in the future, moving out of an FHA and into a conventional loan can not only help lower your rate, but also potentially drop that mortgage insurance that you're paying every single month. That alone could save you hundreds of dollars each mortgage payment. The next thing you could do is open a home equity line of credit while you still qualify. Remember, don't use it unless you have to, but just know it's there as a backup. Trying to get one after you lose hours at work or miss a payment, that's nearly impossible. The next thing is talk to your lender early. I can't stress this enough. Don't wait till you're already 30, 60, 90 days late to reach out to me or to reach out to your loan officer. At that point, your options shrink dramatically. But if you talk to us early, you may qualify for loan modification, forbearance, or even some payment plans. And the next thing is prioritize your mortgage. At the end of the day, the mortgage keeps a roof over your head. That comes before subscriptions, before extra expenses, before that one extra meal out, even before most other debts. Protect the roof, then figure out the rest. And remember, lenders and banks, they don't actually want your house. They want you to stay current. They want you to keep making your payments. So the earlier you communicate with them, the easier it is to find solutions. Now let me be clear, most homeowners today are doing just fine. Equity levels are strong and the majority of people are making their payments on time. This isn't a message about fear, it's about awareness. The people that lost their homes in 2008 and 2009, they weren't all reckless. In fact, a lot of them just ignored the warning signs till it became too late. In 2025, you have the advantage of history. You know what can happen, so use that knowledge to protect yourself. So here's what I'll leave you with. If you're feeling the squeeze, don't wait. Reach out, let's look at your options. Whether that's restructuring your loan, planning for a refinance, or just making sure you have a safety net in place. If this video helped you, hit that subscribe button and share it with a friend or a family member who owns a home and may be starting to feel the cracks a little bit. And remember, staying informed is how you stay prepared. I'll keep breaking down information for you every single week, but that's all I have for you today. Thanks for watching, and I'll see you in the next video.